stopped carrying the market, inflation refused to cool cleanly, and oil finally gave traders a release valve. This briefing breaks down the Nasdaq selloff, semiconductor weakness, sticky PCE data, falling crude prices after Hormuz relief, mixed U.S. growth numbers, and the PMI split showing U.S. resilience while Europe and the UK stay fragile. Welcome back. This is the weekly market recap, and the first read is blunt. Tech stopped carrying the tape. The week's context was clear. Tech had one of its worst runs in a year. That matters because the AI trade had become the market's leadership engine. When that engine starts missing, investors do not just sell one stock, they question the whole growth premium. A growth premium is the extra price buyers pay for future earnings, and higher rate anxiety makes that future less valuable. So the story was not panic everywhere, it was leadership breaking first. The cleanest proof was the weekly index split. The Nasdaq was down about 4.8% for the week, the hardest hit because tech and AI names dominate that index. The S&P 500 fell about 2.1%, which tells you the damage had spread into the broader benchmark. But the Dow rose about 0.6% and even touched a record high, showing buyers still wanted old economy and defensive exposure. That is rotation, not a full liquidation. Money was moving away from the expensive leaders, not leaving the market completely. The sector tape made the warning sharper. The VanEck Semiconductor ETF dropped about 7.3%, putting the AI hardware trade under real pressure. Healthcare moved the other way, rising about 7.3% as capital looked for a steadier place to hide. That tells you the market was not just reacting to one bad headline, it was repricing leadership, margins, and the durability of AI spending. The next pressure point was the S&P 500's 50 days moving average, a common line traders use to judge short-term momentum. If the S&P 500 quickly recovers that line, the rotation can stay contained. But if sellers keep it below that threshold, the Nasdaq weakness can start to look like a broader risk signal. So the key thing is confirmation, tech needs buyers, chips need stability, and the next test comes from inflation. After tech cracked, the macro problem was simple. Inflation still would not give the Federal Reserve a clean exit. The June 25th PCE report showed the Fed's preferred inflation gauge at a 3-year high. PCE is personal consumption expenditures, and markets care because the Fed treats it as a core inflation dashboard. The key thing is this: consumers were still spending, but prices were still too hot. That combination keeps rate cut confidence limited, because strong demand gives inflation more room to stick. Washington can talk about affordability, oil, and economic pressure, but the market still has to trade the numbers. The cleanest chart is inflation against the Fed's target. Headline PCE was up 4.1% from a year earlier in May. Core PCE, which strips out food and energy, was still up 3.4%. The Fed target is 2%, so both readings were still far above the comfort zone. Month to month, headline PCE rose 0.4% and core rose 0.3%, matching April's pace. That tells you disinflation did not accelerate. It stalled at exactly the wrong time for growth stock bulls. The demand side also stayed firm. Personal income rose 0.7% in May after being flat in April, while disposable income also rose 0.7%. Real disposable income rose 0.3%, reversing April's 0.5% drop. Spending rose 0.7% in current dollars, and real spending rose 0.3% after being flat in April. Services added $94.3 billion of spending. Goods added $61.8 billion. The market takeaway was not recession fear. It was Fed flexibility getting squeezed. If inflation cools next, yields can relax and risk assets get breathing room. But if spending stays firm while core prices stay above target, the bar for easier policy stays high. That is why the next chapter matters. Oil relief became the one place markets saw inflation pressure ease. The inflation story got one release valve this week: oil lost its war premium. A war premium is the extra price traders pay when supply could be disrupted by conflict. On June 22nd, US-Iran talks showed encouraging progress and a 60 days roadmap toward a final deal. That mattered because the Strait of Hormuz had been the market's biggest energy choke point risk. The White House backdrop stayed relevant because sanctions, diplomacy, and Middle East security were all part of the pricing channel. The price move was the proof. Brent fell below $80 early in the week as traders moved away from a blockade scenario. By June 24th, Brent was near $76.30. WTI was near $72.43, so U.S. crude was easing too. By June 26th, Brent was near a 4-month low around $71.52. WTI fell below $70, with one quoted level near $69.46. This was not just an oil trader story. Cheaper crude can reduce pressure on gasoline, transport costs, airline margins, and consumer inflation expectations. That is why lower oil helped ease fears of extra Federal Reserve tightening, even while PCE inflation stayed sticky. Brent was the starting shock absorber in that cross-asset trade, and Treasury note futures reflected some of the rate relief logic. But confirmation still matters. If tanker movement keeps improving, the oil shock keeps fading, and inflation pressure gets more breathing room. But if maritime security incidents return, the same choke point can rebuild the risk premium fast. So the market got relief, not resolution, and the next test shifted back to growth data. After oil gave markets some relief, the US growth data gave a less comfortable message. The headline looked better, but the details underneath looked softer. On June 25th, first quarter real GDP was revised up to 2.1% from the second estimate of 1.6%. GDP is the broad growth scorecard, but this was a backward-looking number. That is why markets did not treat it as a clean green light. The key thing is the split, stronger reported growth, weaker nearby demand signals. The GDP revision itself was real. The advanced estimate had been 2.8%. The second estimate dropped to 1.6%. The third estimate came back up to 2.1%. That sounds constructive, especially after fourth quarter 2025 growth of only 0.5%. But the Bureau of Economic Analysis also pointed to imports subtracting from growth, and consumer spending was not strong enough to end the debate. Then the May data pushed the other way. Durable goods orders fell 4.5% month over month. New home sales fell 7.3%, a clear hit to rate-sensitive housing. New homes for sale rose 2.3%, so supply was building as sales weakened. That tells you buyers were still under pressure from affordability and rates. The trade data added one more caution flag. The goods deficit widened from $83.00 billion in April to $105.8 billion in May, which can weigh on second quarter GDP. So the market did not get a simple soft landing confirmation. It got mixed growth, and the next test was the PMI split. The final macro signal was divergence, not collapse. PMI surveys ask companies whether activity is improving or weakening, and 50 is the expansion line. On June 23rd, U.S. business activity kept expanding while Europe and the U.K. looked weaker. That gave markets another reason to treat the U.S. as the cleaner growth story. But it also kept the rotation complicated, because stronger U.S. activity can support earnings while keeping rate pressure alive. The U.S. side was the strong side of the split. The U.S. composite PMI rose to 52.2 in June, up from 51.5 in May, and above the 51.2 forecast. Manufacturing rose to 55.7 from 55.1, beating the 54.8 forecast and reaching the strongest level since May 2022. Factory output grew at the fastest pace since July 2021, helped by the largest new orders rise in just over 4 years. That is useful growth, but not necessarily easier policy. Europe improved, but it did not break back into expansion. The eurozone composite PMI rose to 49.5 from 48.5, still below the 50 line. UK services fell to 48.7, below the 49.3 prior reading and well under the 50.5 forecast. That 48.7 reading was the clearest negative surprise. Market red was growth differentiation, U.S. resilience, European fragility, and weaker UK services. White House trade policy still matters here because tariffs and supply chains feed directly into factory sentiment. If manufacturing holds, growth can stay supported. If services and employment weaken, the soft landing story gets thinner. That is the market report for this week. Thanks for watching, and I will see you in the next update.